thing. Hey guys, so I was planning on going live earlier, and this is my first time ever going live. I guess whenever I tried it earlier, I was using StreamYard, and I didn't know how to use it. So I was trying to figure that out, and I deleted it, and it went back, and then my software went out. So I'm just I'm recording this to answer because I had two questions that came up. One question was, why is this process safer compared to if I just had like a regular bank account at Chase Wells Fargo? It's quick, it's accessible. And then the other one was, how do I become a private money lender with this process? So let's address those two, okay? And then if you have any more questions, you can I'll do another one next Wednesday, and hopefully I can actually get it to go live. And then you can put you can put a comment below or put a question below if you have any other question. If I can address it before next week, then I'll do that. But so let's address this two question, right? Why is this process better than a traditional bank per se? So to answer that question, let's step back a little bit. So whenever I have this conversation with somebody, I'm not saying like, hey, this is what you need to do, because everybody has different problems, right? There's different problems, there's different solution. Now, with what we're talking about here, maybe this is not the right strategy for you. Maybe your strategy is completely different, right? There's people that come to me that have a lot of money, then I have to maybe 20 million and up. I have to send them somewhere else because they have a completely different problem. Those people don't have an efficiency problem. They have a problem that's going to happen when they pass, right? It's called division division with their state, and then also erosion on the taxes end of things, right? So those are the problem with somebody that's a very, very high net worth. Completely different. Now, if we're just talking about how to strategize as far as how to be more efficient with your money, there's a lot of different products out there. There's tons of different products in the market. You have your 401k, you have your IRA, you have what we use, which is a whole life product. I mean, there's annuities out there. There's tons, right? Many, many, many different products. There's not a single bad product. It's a matter of what you're using that product for, and is it the most efficient product? Is it the best environment for your money? I don't care what product I use if it gets me from point A to point B the fastest, right? So I hope that kind of makes sense. So from that perspective, let's step back. We'll look at the different products and why we end up using this specifically high cash value of permanent life insurance for very specific reasons. Right? And then we can go over that here. So when we looked at all the different products out there, this is what we came up with, right? There's tons of products out there. This is what we came up with. You have tax deferred growth, right? These are the ideal benefits. If you're looking at all the product in the market, these are the ideal benefits, right? You have your tax deferred growth, tax-free distribution. You have your competitive returns, right? You want to at least pace with inflation at a minimum. High contribution, you have to be able to contribute as much as you want based on your goals, right? You have deductible contributions. Collateral opportunities, you have to be able to collateralize your money, right? And then safe. Now, for the purpose of what we're doing, this is very, very important, because this whole strategy is based on collateralization. It's based on creating a spread. So every time you use your money, you're creating a spread. And as you're building this family bank or this private reserve account, your spread is going to get bigger and bigger. This is where when I tell people, they get confused. This is when I tell people, one of my accounts, right now, I deposit 12,000. It turns into, I think, 17 or 18, because I've already injected time and compound interest on this account, right? So just by writing a check, it automatically shifts to that. Imagine if you have an account like that. That's not When I say safe, it's not part of the stock. It's not part of the market, right? It's completely outside of the market that this happened. There's no other place in the world that this can happen, right? So when we're looking at the ideal benefits of all the accounts out there, this is what we have. So far, we have the tax deferred growth, tax-free distribution, competitive returns, high contribution, deductible contribution, collateral opportunity. It has to be safe. Next, no loss provision. All that means is once your account hits a floor, that's your new floor. So for example, if I have $100,000, when it grows, because it will, when it goes to 105, that's your new floor. When it goes to 110, that's your new floor. When it goes to 120, that's your new floor. It can never go down, and that's a guarantee. So we're looking for those types of benefits, guaranteed loan options. So you have to have access, you have to be able to borrow from your account, your private reserve account, when you need the money. Because this is the whole point, right? The point is we're putting our money in a position where it gets better and better. And when you need that money, you have to be able to access it. Okay, so this is the guaranteed loan option here. Meaning they will let you use your money when you need it, no questions asked. Unstructured loan payment. Now, this is very, very important. And a lot of people get confused with this because whenever we're looking at, especially when it comes to business owners and investors, and I just had somebody that came up and had the same question, right? If you have a business and you don't know when your next paycheck is going to come in, or let's say you have $100,000 that you're borrowing to invest, right? Or if you have cash, some people will like to pay cash because they don't want that obligation. But if you are borrowing money and you invest that, what happens normally in the market? Like let's say your mortgage, right? You have a monthly payment that you have to pay. It's an obligation. If you don't pay that monthly payment, guess what? After a month, 60 days, you're gonna get those phone calls, right? You're gonna get this letter saying that, hey, you're about to get foreclosed on. If you had a car payment that you didn't pay, you're gonna get nasty phone calls, right? So unstructured loan payment is very important because you don't want to be under the gun when it comes to using your money, especially when it comes to investment opportunities. So you should have a process where the loan payment is unstructured. That means I can pay $0, I can pay $1, I can pay $5, I can pay $50. It's up to me. I make that decision, right? So an example of this is like whenever I did a flip in Sunnyside here in Houston, I borrowed $50,000 for my policy, and whenever I structured the payment, I just told them to automatically withdraw $100 a month until my flip is over. So when the flip was done, I got all my money back. Then I paid my loan and I kept the profit. So unstructured loan payments. Liquidity, use, and control. Always. You've heard the term cash is king, right? I disagree with that. Access to capital is king. So and I'll explain that to you later. If you have access to capital, something comes up, you can take advantage of it. Usually with the way it's structured with cash, it's like you'll have cash, you use that money, so you use that money for whatever reason, you're draining your tank, you're losing the opportunity cost on what that money could have earned for you. Okay, so liquidity, use, and control of your money. You want to have your money. You want your money to be liquid. You want to be able to use it whenever you need to, and you want to have full control of your money. And then additional benefits. Now we'll talk about this because the more I'm into this space, the more I see how important these additional benefits here are, and we can discuss that later because there's a lot more to this than what you see here. So these are the ideal benefits, right? So when you're looking at the market and we're saying, hey, okay, what is the best product that we can use in order to get me from point A to point B the safest and the fastest way possible, right? Where you can control the velocity of your money, meaning You can literally control it. My clients, I can tell them like, hey, you're gonna be right here 5 years from now, 10 years from now, you're gonna be right here at a minimum if you follow the process. So you can control the velocity of your money if you have more control of your money and you have a methodology that you're attaching to your business or to your life or to your family that you can follow, right? Like a strategy around it. So here we go. So if you're looking at a regular savings account, Chase or Wells Fargo, and this goes back to the question earlier, why is this thing better compared to like a regular checking account? So here goes. There's only 5 out of all the benefits that's checked off. Now, I don't want to make this video really long, so I'm just gonna highlight this. And if you have any questions regarding each one, we can go dig deep into each one of these benefits. But you have 5 out of the 12, right? So let's look at another account. Let's look at a CD. A CD has 4 out of the 12. Let's look at a HELOC. Okay. I have a course on this. I have a mortgage master course on this. There's only 2 out of the 12. Okay. So sometimes I have clients that say to me, "Hey Joe, how do I structure this? I want to pay cash for my house." Now let's look at it, right? Nothing wrong with it, but let's look at it. Let's look at our strategy and let's look at paying cash. Let's look at the math and see what the numbers are. 99% of the time, it's this strategy, not paying cash. Because if you think about it, if you put your money, and then I want you to think about this from the perspective of inflation and how it affects your dollars, right? I was telling this story on one of my webinars. I was saying that, hey, a long time ago when I first moved, well, not when I first moved into this country, I was probably 2 years into this country. My mom was working like 3 jobs. You know, I remember she would give my dad $20 bill to go a week, $20 a week to go to the grocery store to feed a family of 5. Imagine that today. What can a $20 bill buy today? So your dollar today, right? This was what, 1994? So your dollar today, that's as valuable as is going to get, right? Your dollar, that dollar 30 years from now is not going to be as valuable. So if you're paying cash for your house, you're trapped in the money is trapped inside your home, right? Earning 0, meaning inflation is destroying your dollar. So if you're putting 200,000, 300,000, 400,000 inside your home, the house, the appreciation appreciation is not the same as equity, okay? Because equity has 0 rate of return. The house will appreciate, will crash, and hopefully the real estate, it does this, right? Eventually it will go up. No matter what you do, whether you pay $400,000 for your home or you pay 3.5% for your home, a down payment, the house is going to do its thing regardless, right? So appreciation is completely different than equity. So the house will appreciate anyways, it could crash, right? You have such scenarios like 2008, this could happen again where it can crash, right? The value of your house is eating up the dollar. So this is why a lot of times, maybe the house is not the best. So we're always exploring different options. What is the best, right? Maybe this is not the best place to store your equity. Margin, well, 5 out of 12. All I'm going to say about this, if you're ever day traded, which I have a very, very strong background on day trading. And before I was doing this, I was doing a lot of day trading and margin call, okay? Margin call. Look that up if you don't understand the stock market and how it works when it comes to your portfolio. 401k. 401k and other qualified plans, which is your TSP, 403Bs, it only has 4 out of the 12. almost 90% of people that have jobs, have retirement plans, it's all sitting in these types of accounts. Millions and millions of dollars are sitting in these types of accounts, right? And there's two main factors here that you don't control. You don't control the tax because you have a business partner. A lot of people don't know this, but you have a business partner when it comes to these accounts. You have the tax and the tax calculation, meaning you don't control those two pieces, okay? So the government can wake up tomorrow, and I mean, this is another thing that I ask people. Do you think taxes are going to be the same, higher, or lower in the future? 99% of the room, when I'm doing a presentation of 50 people, 99% of the room will say it's going to go higher. So if it's going to go higher, why are you postponing the taxation, right? So there's certain ways you can still benefit from this because some companies will do a match. I always tell people if somebody's doing a match, go take advantage of that match. But other than that, it doesn't really make any sense to postpone it, right? To postpone your taxes because they can shift it, right? Like what's going on right now is that they're saying that there's a percentage that you're getting taxed on your income, but they're also moving the threshold of rich, right? Tomorrow or something can happen and be like, okay, rich is now $100,000. Rich is now between $100,000 to $150,000. It's now considered rich, and then you're gonna get taxed at a higher. They control that piece. We don't control that. So we're just trying to say it's like, hey, if there's a better way, then we can explore that way. And this is where we go into this permanent life insurance, right? So going back to your question, why is this better? Many factor, but this is one because you have all the benefits here except for deductible contributions, and there's even ways to get this, right? But right now, let's just explore this. Like you have all of this. So I hope that kind of made sense with that question. Why is it this better? So another thing as well. Let me illustrate this. When it comes to infinite banking, let me whiteboard. So when it comes to life insurance, a big question that comes up. Okay, well, Joe, that's good. Life insurance has all this benefit, but how does it work? Like what if they go out of business? What if they where are they putting their money, right? What are they investing in? How can you guarantee that the money is going to be sitting over there? Now, if you're looking at this. Yeah, let's look at this right here. So let's look at this really quick. So let's pretend that this is a life insurance company, right? And if the life insurance company, when I've never, so let's step back a little bit. I've never, life insurance, whole life. So all companies have two accounts, okay? Let's start with there. So let's represent these accounts over there. They have, So nobody has ever come to me and said, Joe, I want life insurance. Thinking back, that has never happened, right? They're always coming up to me like, hey, what is this infinite banking concept? How does this work? I'm a real estate investor. So a lot of real estate investor clients love this process because there's a lot of benefits that comes with this strategy, especially when it comes in when it's combined with real estate. But just to kind of illustrate it, if somebody comes in to like a regular, let's say, life insurance agent and they say, hey, Joe, I want $1 million death benefit. The way it would be designed is they would structure it to where there would be $1 million death benefit, right? And let's to make the numbers simple, to kind of simplify it, let's say I want $1 million death benefit, right? That's 6 zeros, okay? Let's just say the premium, meaning the premium for these this $1 million death benefit, and let's just say it's $10,000 a year, okay? To just kind of simplify it. So as soon as somebody comes in and they get approved for this amount, right? Let's say somebody comes in, a client comes in and says, okay, Joe, I wanna go buy $1 million worth of death benefit, and then the insurance company says, okay, that's gonna cost you $10,000 a year. What happens with these insurance companies is they have to take that $1 million, okay, let's just say, that $1 million out of their investment account, right? This is their risk account, and move it into their safe account. And the reason why is they have to pay. If that person dies tomorrow, they have to pay out that $1 million, right? So this is their safe account. So safe account earns between 4 to 6%. And then you have your investment account, earns between 10 to 15%. Okay. Now these companies have billions, if not trillions of dollars, right, sitting in these accounts. These companies have been around for over, in some cases, 200 years, right? Most companies have been around for over 150 years, have been paying dividends unbroken. Okay, I want you to let that run past your brain really slow. Unbroken dividend payment for over 150 years, okay? There's a lot of people that are very wealthy that use this process, okay? This is just now trickling to like the you and me kind of level. So somebody comes in, they say, I want $1 million death benefit. That $1 million gets taken out of the investment account, and it has to be moved to the safe account, because if it's not moved there, they can't have this risk, right? This one has market volatility, this one doesn't. So if this account goes down, then this is why they're operating in a completely different set of mindset. It's called Austrian economics, if you ever heard of that term. Currently, this Keynesian economic model that we have right now, if you were to go to a regular bank, this is why this happened, a few months ago. You have a lot of liquidity issues with banking. Banks were closing, right? I don't know if there's a couple of maybe like bank runs where like they're closing the doors, because a lot of these banks, what happens to them, if somebody deposits $1 million into these banks, they can literally turn on the computer and turn that $1 million into 10 million just by like a press of a button. Okay, it's called fractional reserve banking. Okay, so they can make $1 $10. They can make 1 million into 10 million, and I don't know if that's been changed a little bit. It might be 1 to 7, 1 to 10, but it varies between those numbers, right? Between where they deposit a certain amount and they can just turn it and then they can lend it out there to you and me, right? For our cars, for our house, for everything, right? So they have the ability to make money out of thin air, okay? These companies don't have those privileges, meaning if this person dies tomorrow, they have to pay it out, okay? So I want you to understand this piece, because it's very important, that this is why these companies have been around for so long and they're liquid. And they've been profitable since World War I, World War II, Great Depression, been profitable in those environments. So now, what is infinite banking? So let's step back, quick back right here. There's a gap right here, okay? Forgot to mention this earlier. This gap over here represents the money. The gap is so going back to this account, when the insurance company moves $1 million into the safe account, over here they're earning 10 to 15, over here they're earning 4 to 6. What happened? They lost money, right? They lost that spread. There's a gap. They lost that spread between these two accounts because that $1 million could be earning more than 4 to 6. So this is what this gap represents. That's the cost to insurance. They have to be able to recoup that gap in order for them to say, okay, you can have access to all your money. So this is why a lot of times it takes a while for that cash value to build up. If you're designing it like a traditional straight lace, that your first year, no cash value, second year, no cash value, third year, you have a little bit, right? Because you have that massive gap over here that the insurance company had to recoup that money in order to make what they lost, right? To make up what they lost. So when you're depositing your premium, where do you think this premium is gonna go? Let's say 1 year, I'm gonna send $10,000. Where do you think that's gonna go? It's gonna go over here. That's how they're gonna recoup it. And then the next year, I'm gonna deposit another one. The next year, I'm gonna deposit another one. And eventually, they're gonna recoup the money year after year. And as you can see, the gap here is being smaller, right? And eventually, you're gonna have the same amount, right? Your cash value is gonna equal whatever you put in. But it takes longer if it's designed this way. So now let's step back. What do we do? What is infinite banking? We design it a little bit different. Same person says, hey Joe, they come to me. They don't come to me for the death benefit. They say, Joe, can you design this infinite banking product, right? So that I can maximize my cash value. I can inject my cash value. That's how we design it. There's infinite design, but that's how we design it. We're designing it to where that's the cash value, that's the death benefit. So maybe on a $10,000, your death benefit might be $200,000 first year. But as you're building your cash value, your death benefit your cash value is also chasing your death benefit. So the cost of insurance is very small. This is why you get your cash, your money, you have access to your money almost right away. It doesn't take as long as the other design. Yeah. So this is why these companies are safer, because they have this long history to where they're liquid, right? So the other question was private money lending. Okay, now that being said, private money lenders, most likely I will go that route, but currently, like I'm not looking into that. But as far as how that process would work is, the first thing I would do if I want to learn more about it is I would probably go network in your RIA groups around town and maybe meet a couple of private money lenders, invite them for coffee. I would say between 5 to 10, sit down with them, talk to them, ask them questions. A lot of them are very helpful. But the general idea is you have to build cash first, right? If you want to become, besides that, or you build capital. I know somebody that started off with $100,000 and then he started doing really well. Like he grew that 100,000 into like around like 400 in a matter of like a couple of years. And his friends started telling him like, hey man, like I have some money over here. Why don't you do this with my money? So he started pulling this capital to where right now I think he has like $2 million to where he's lending to different real estate investors. So That's one route to do it. And then the other route is to, if you have money, you gotta store capital first, right? You gotta start saving money first. And then once you have enough money and you're ready, maybe you start an LLC, and then maybe you open up a business account. And then once you open up that business account, then you can maybe talk to an attorney and draft an agreement so that you're protected. And again, I don't have those documents, but I would suggest talk to some local lenders. And there's also books out there. There's tons of courses on YouTube. I mean, the one that I'm looking at right now for this is this is Patrick David's book. This is the book that I have on it. Can you see that? Here we go. There's a glare there, but it's called Lend to Live. It's by Beth Pinkley Johnson. I'm about like an hour in this book. So far it's good. So this one will probably dissect a lot of those little gaps that you have, but everything's in YouTube, guys. Like if not, I would suggest talk to somebody, talk to a private money lender in your RIA group. If you have like an IRA group, a lot of those guys lend private money, and you might be able to just get a copy of their contract and you can use that for your own. But the main thing with private lending is you have to understand how to evaluate properties, because whenever you have somebody asking you, if you don't evaluate your property correctly, then you're gonna be in trouble, right? So you have to get really good at like doing comps, doing maybe construction, right? If somebody comes in and then you can look around, you can say, okay, this is gonna cost me $30,000. You have to be able to have that eye if you want to be like a private lender, or you have a team that can help you with that. Because I've had private lenders. I think the last one I spoke to, he just had some issues, with in the beginning, whenever he first started this, to where he didn't really understand that part. So he was learning as he goes. But if you understand that part, if you have somebody in your team that knows construction, then that can help you out with that process. But as far as like this process and how it goes, I'm gonna end this right. We're at 30 minutes in, so I'm gonna make this quick. So this is your personal economic model, right? Let's look at this really quick. So if you've never seen this before, this is just how your money flows into your system. So I'll make this kind of quick. Most people, right? You either get paid. There's a reason why this is larger compared to this two, because this is your lifetime capital potential. This is every dollar that you're going to earn in your life. So when you're coming in and you have a W-2, this is what happens. Your money come in, let's say bi-weekly, and then some of your money will go into the qualified plans, right? This is your 401ks, your IRAs, traditional IRAs, 403bs, TSP. The Uncle Sam takes a cut, right? Your business partner takes a cut. And then this is the place where you control this piece, right? Your lifestyle regulator. So if you're saving money because you want to become a private money lender, you want to at least get this to about 80%, right? Ideally. If you're making a lot more, depending on where you want to start, between 80 to 90% is good. So you can start putting money into this tank, the safe tank. And then this is your investment tank, right? Because once your money goes through here, through your lifestyle, which is your home, your car, your school, entertainment, food, cell phone, that money is gone. That money is gone forever. So the idea is, if you want to become a private money lender, then you need to start saving. I wouldn't put it here. I have to store your money somewhere where it's safe. Because this one, the nature of investment is like this, right? It goes up, it goes down, it goes up. You don't know what's going to happen, right? You don't know what's going to happen. And then savings should only go up. Now, a lot of private money lenders, right? We discussed the different benefits earlier in the beginning of this video. Is what they're doing is, if they have a business and you're a private money lender, you find a deal, somebody comes up to you, right? You lend them the money, Your money is kind of like circling here, right? You're putting some there in your business and you're putting some here in your investments. But if you have what most of the private money lenders are doing this, they have a bunch of cash, and then somebody comes in, right? Somebody comes in, they lend the money, boom. And then they wait for the money to come back. The guy is paying monthly, interest only loan, and eventually the investment comes back, it's a little bit higher. Right? That might be 6 months, that might be a year, depending on how much money you have there and how many deals are you lending to. But they're constantly draining the tank. They're constantly draining the tank. Now, what we're trying to say is, if you have this process in place, instead of you draining the tank, when we're talking about that product earlier, you're building cash here. And you have a massive death benefit attached to it. You also have long-term care attached to it. When somebody comes to you, instead of you draining the tank, you collateralize. Okay? And I'm going to show you why that's important. So if somebody was, let's say, saving, let's say, he wants to be a private money lender, is saving $20,000 a year, right? Saving $20,000 a year, that money is earning, let's say 6%. Let's just put 30 years. Let's say he drains the tank every 3 years and it takes him 2 years to fill it up. Okay? So if you're doing this, look how much money you lost. Okay? By emptying the tank, it resets the compound interest curve. Okay, that's why you never want to drain the tank. So, I mean, if you're looking at different deals to where, you know, you're draining the tank a lot, right? You're constantly draining it. Even if you 1-to-1, you're still losing money. That's $100,000, a lot of money. You put that in your later years. What if you're draining the tank every 4 years, and it takes you 3 years to refill it back? $1 million in lost opportunity cost because you drained it 4 times. Okay, this illustration, this was a huge aha moment for me. This is how I understand this process. You never want to drain that tank. Instead of doing that, we can go this route to where you're putting money into the tank, and then when you need that money, you collateralize it. Okay? No more draining the tank. So your money is never encumbered. So for example, so if you have, like, let's say $1 million in here, right? Let's say you have $1 million sitting in there, and then you borrow, let's say you're borrowing at the same or a lower rate. Let's say you're borrowing, let's just make this simple. Let's say you're making 5% on your $1 million, okay? What is that? 5% on your $1 million, like about 50,000, right? So you're making 50,000 a year on this, okay? And then you lend out $500,000 to, let's say, 2 different real estate investors at 5%, and then they're paying you 12 with 2 points. Imagine that spread to where your money is making over here. So you're basically lending money, borrowing money, and then making money at the same time. Now, we can go deeper into this, but that's the general idea of becoming a private money lender when it comes to this space. I think 3 people that I'm working with right now that has these policies, you know, like that they lend their money, and that's all they do, right? They just do this, collateralize. The money just keeps on growing and growing and growing. Collateralize. So I hope that makes sense. Sometimes with this illustration, it does help. So I hope that helps, guys. It's been about this. I wanted to keep it like around 30 minutes, so this should be good. And if there's any other questions, let me know. I'll jump on live next Wednesday, and as I'm building this group right now, because I think we're at 65 people right now. Thanks for joining. If you're listening to this. So the way it's going right now, by next year, we're going to have over 1,000 people in here. And hopefully everybody's engaging and everybody's asking questions, because this is also how I get better, right? I have some really good stuff right now that I'm working on, man. I have some strategies right now with trust to where, I mean, I don't want to say it yet until I fully understand it. But the general idea is you can basically create a shelter around a trust around your entire ecosystem to where you're not paying taxes, right? You're just deferring taxes. You don't even have to do a 1031 exchange anymore, And you can do this whether or not you're a 1099 or a W-2 employee. So I'm looking at those structures right now because those really benefits like the high net worth individual, even somebody that's making like 200,000 a year, Like I know I've got a couple of friends here that are paying 50K or more in taxes, right? Like we can eliminate that. What are you going to do with a 50K? Let's create an account like this and store those savings into a safe tank to where, we're just waiting for those investment opportunities to come along. Okay. So, again, if you have any questions, post on the comment below. And, other than that, I'll create maybe 1 or 2 lessons or maybe 3 lessons this week. And then next Wednesday, I will jump on a live call again and see if I can answer another question for you. Okay, take care, guys. Have a good one.